So everybody is there or somebody is missing? Maybe one or two. Huh? Extra would be there. Oh, wonderful. So you have started liking the lectures, isn't it? Okay, great. So let's start with currency futures. Okay, some person is gone out. Yeah. So last time what we did was we understood what a forward market basically. We are trying to hedge our risk. Okay. So when we are exposed to the currency risk, the currencies can go in our favor or can go against our favor, and we can lose money or we can gain money. Now, a businessman would normally hedge. Okay. uh, and he's not bothered about he's bothered about his business only. Okay, so whatever he's going to gain out of his business transaction, so he should be only focused towards that. And whatever is happening in the currency market, whether it is bringing him some profit or loss, so he tries to hedge it himself through various instruments. Okay, so we talk about currency futures. So who is holding the mic? Yeah, just read a couple of slides, just one slide only. Yeah, this one. Can you see the slide? Yeah.
Every business is subject to the risk of unforeseeable changes in business environment. Volatility in exchange rates affects your business growth and can be significant. If you are an exporter, importer, or have foreign currency loans, you are directly exposed to exchange rate fluctuation. It is possible to mitigate these risks by using suitable hedging instruments.
So basically, whenever you are exposed to foreign currency risk, so you would like to cover that risk and hedge that risk. Okay. So today we are going to understand. Okay. And we are going to first. Last time we did through forward contracts. Okay. Now there is yet another way of doing it through futures contract. Now forward contracts are physically settled. That means when you go to the bank, you will get dollars. Okay, you make the payment, you get dollars, or you have to deliver the dollars if you're an exporter. If you're import dollars, you need dollars. When I say dollars, it means any other currency. Okay, so as an importer, you would require dollars to make the payment to someone. So the bank will give you at the rate what you have fixed with the bank for a forward date, and on that date you're going to get dollars delivery. I mean, you will get the dollars this thing, and you have to make payment which was agreed upon. Similarly, when you are an exporter, you have to give the delivery of dollars, and he will convert that dollars into Indian rupees, and the money will come into your bank account. But in uh, whenever you are trading in futures, okay, doing the same thing, you are hedging your transaction, but in this case, you are using a stock exchange as a medium. Okay, you're not going to a bank. And here, everything is cash settled. Either you make money or you lose money. You will not get dollars or any other currency which you are seeking for. So, and that gain or loss is going to offset your underlying transaction as an importer or an exporter. So, we are going to understand that through example. So, what's your good name? Jasmine, just listen. We are going to talk about the same thing, what you are saying, okay? But in a fashion you understand it, okay? So we are going to talk about everything. First, we'll start, normally I start with an example. And through an example, I take you to the stock exchange also and go to the market and try to hedge our currency risk, okay? And in that process, you understand all nitty-gritty of the all the contracts, okay? But now I'm just starting with little bit of understanding the theory, and then we move on to the practical question. Just 2 3 slides to cover up what it is, okay? Normally, an example itself resolves everything. If there is short of time, I just start with an example and explain everything through an example, all the finer parts. Okay. Currency derivatives are future and options contracts traded on exchanges similar to like stocks. Okay, you can go to the stock exchange. I mean, for future and options, for stock also, you can go to for currencies, you can go for commodities. Okay, you can go for interest rates. Okay, there are 4 or 5 kinds of underlyings which you can always take care. And we are going to understand interest rates, futures and options, as well as currency futures and options during our journey. Little bit of commodity, but I mean, if you understand two, then the third one is just follow up with that. However, the underlying assets of these contracts are currency pairs, such as USD INR, Euro INR, Japanese INR, and Pound INR, rather than stocks. So here the underlying, so there are always pairs. Whenever we are talking about I want to buy dollars, so my currency is rupees. Now, from an Indian perspective, the other currency pair will be Indian rupee, and the second currency will be a foreign currency. Now, these are the four pairs which are normally dealt through the stock exchange. Okay, no other currency you can, trade through the stock exchange. Okay, or you have to use a cross currency for doing it, but this is only the mechanism through which you can trade. Major 80% of your trade is fixed through this. Now, future contracts in USD INR, Euro INR, Pound INR, Japanese Yen INR. Okay, maximum 12 monthly contracts are there. Whenever you go to the stock exchange, you will find there are 12 contracts open. Now it is like, November, December, January, February, till October. So there will be 12 months window you will get. Fine. Now, depending upon, suppose I require to make a payment in the month of January. So I'll go to the January contract. For all other contracts become irrelevant for me. Okay. Suppose I'm getting a payment in the month of March or as late as September 2024. So I'll go to that window only. For me, that contract will be only valid. हाँ वही अभी जा रहे हैं अभी हम जा रहे हैं just listen, okay, and everything will get answered. Just listen for few slides. Whatever questions you have, just keep it to yourself, okay, and if they're not answered, I'll give you an opportunity after maybe half an hour. You can ask, unless you're not understanding what I'm talking about in a slide particularly. Of course, futures and options are very complicated kind of instruments, and it takes time to settle down in your brain. Okay, to make the markets for USD INR futures deeper and more liquid, NSE has now launched weekly contracts for futures on USD INR. So there are even weekly contracts instead of monthly contracts, 12 monthly contracts. Now think about, you have a transaction in the month of, say, January. You're going to get dollars from somewhere. So you want to hedge yourself only, when you're going to get your dollars in January. So you go to January contract and you will find a window there. And now we'll go to that window and understand what is that. Okay. Similarly, there are weekly contracts also. Okay. For dollar versus Indian rupees. Okay. Fine. Now, you can even, suppose if your payment is falling on a particular day, so you have to choose that contract. If it is coming on 7th or 10th of, say, January. So you'll choose the second week contract of January. Even if you choose, a January contract, full month contract, you can still, hedge your transaction for any date in January. Okay. But the weekly contracts make you more liquid, and the price discovery happens much better. Okay. I'll talk about what is that price discovery. That happens much better if it's a weekly contract. Okay. So, at any time when you go to the stock exchange, there will be 11 serial weekly contracts expiring every week. Okay. And they will be expiring on every Friday, and 12 monthly trading cycles. And that will expire, say, on the last 2 days before the month closes. Okay. 2 working days. Okay. So, we'll talk about that. Okay. Right. So, last trading day. All weekly expiry contracts will expire on Friday and expire of the expiring week. All contracts other than weekly will expire 2 days working prior to the last business day. Now, that's why I don't cover the theory first, because, when I'm telling you, so you can't make out, what I'm talking about. So we cover an example, and then, so what I'll do, I'll just straight away move to now, just to give you this thing that there's a lot size of, $1,000. 1,000 euros. So if you have to hedge yourself, it has to be in lots. Suppose I have got $1 lakh to be paid or received, then I'll be taking a shot at 100 contracts I'll be taking a position of 100 contracts. Okay, fine, to cover myself. But if it is going to be 1,700 dollars, so either I have to be, taking 1 lakh, $1,000. I'll be taking 101 contracts. So I'll be sometimes overhedged or underhedged. Okay, because it's a standardized contract. Okay. Fine. So for yen, it is 1 lakh yen. Now, okay. So let's start with a question. Okay. So what I have done is I have prepared, so I have just revised, with the current this thing. So what slides I've shared, I have just gone through the latest one. Okay. Maybe it was July example, so I have covered the recent example, which is, बंद हो गया क्या? Okay. So example on hedging using currency futures for importer. Think that you're an importer and you have to make some payment in dollars. Okay. XYZ is an importer. On 24th November 2023, XYZ Limited wishes to book its outward remittance for 29th January 2024 worth $1 lakh. So just let me check whether this getting recorded. Yeah. So this guy has to, make a payment of $1 lakh. Today is 24th of November. When he's supposed to make a payment? 29th January 2024. So all this which is written in the box means this, that on 24th of November, and you have to make a payment on 29th January for $1 lakh. Now on 24th November, he goes to the stock exchange, and the dollar's future is trading at 83.4875. So it always trades at 4 decimal places. Okay. So that means you can buy the dollars at 83.4875. So this is the LTP, last trading price. So somebody has placed the order. Okay. Hanji? I just spot rate is written at the bottom. So let me finish. Okay. And we'll get it. Okay. ये slide के बाद question पूछना नहीं समझ आया. Okay. So on 24th November, when he goes to the stock exchange and opens up his laptop and goes for online trading, he finds that for the January month window, the dollar future is trading at 83.4875. Okay, as against the spot rate which is given at the bottom as 83.34. So this is the spot rate on 24th. Okay, it keeps changes every day. Okay, so slightly costlier. Okay, because it's ahead of the time, and dollar always carry a premium. Okay, and it is trading at 83.48. And this is the last traded price. Somebody has entered the transaction. Okay, just before I logged on to the system, so I found somebody has purchased dollars at 83.4875. Okay, now this is the market price. Now this is assumed as market price on that particular second of time when I open the window. I can choose to trade at this price. I may not be able to trade because somebody has already entered and the contract is over. Okay, or maybe hanging on the system because he's not able to find a seller. Suppose he's placed a buy order and somebody has not accepted, so this will remain in the stock exchange software. So this is the last order expiring on 29th of January. Okay, fine. And number of contracts. So that means he has to take a position in 100 contracts because each lot size is $1,000. Okay, so he has to buy, okay, 100 contracts. Fine. So what he'll do, he'll buy currency futures 100 contract, say at $83.4875. Okay. Now there are two ways of placing your order. One is at the last traded price, put that price, okay, fine, as a limit price. You can place an order at a limit price that this is the price I want to buy it. If you think the dollar is going to depreciate, so because you're going to book a dollar, suppose you think it will come down, say, to 83 point, as per your study or technical analysis, find that it will come down a little bit. Okay. After seeing the data on the stock exchange, you can make some sense. I'll show you the data in the next slide. So you think that you can even enter at 83.4775. You can make, at a lower price also. So you have a choice. So in that case, you limit your order. Place a limit order or place a market order. That means whatever is the best price available, your order will be executed. Assuming that you have booked the order at 83.4875. Assume that your order got concluded at the last price which was prevailing, and somebody was there in the system who also wanted to sell, and you can see that guy. Okay, so you place the order. Okay, at 83.4. Now the next step is you have to pay a margin money. Okay, which is currently at around 2.50, which can be 2.75 or some nearbout. So there is a margin money. Okay, fine. 2% is called the span margin, and 0.5 is called the maintenance margin or whatever. Okay, so these two margins you have to pay, and it comes to 2.5%. So I would be paying 2,09,187,150 the moment I place, and my order will get executed. Okay, now what I'll get, I'll just go to this window of the stock. I'll just take you now to the stock exchange after showing this. Okay, so you go to the stock exchange, and you were interested to book order for future USD January. The whole contract will be worded like that at the top: future USD INR 29 January 24. Okay, so you're into this contract. Okay, and then you are looking at the window called best 5 bids and offers. So the 5 people who have placed orders, either buy or sell orders, you can view there on the window. Okay, so if you look at total at the bottom, total, there are so bid means buy and ask means sell. So the bidders who have placed the order to buy it, so it is coming on your, like starting with 140, 83.4875. So somebody has placed a buy order, okay, at 83.4, and there are another person who has placed a buy order at 83.4850. Now it will be stacked in this order. The person who has placed at the highest price will be sitting at the top. So these are unexecuted orders. Okay, people have punched them, and their transaction have not been matched so far. Okay, so he has placed the order at 83.4875. The order is in hang. Now the second guy who has placed the order at 83.485, he'll get the second priority. Because if I want to buy at a higher price, I'll get a priority. Okay, this person who places the order at a lower price, he'll get the second priority, and the third priority will be at 83.4825. Okay, and the fourth one, somebody has placed 180 lots for 83.48, and the last guy, the five top buy orders are, and the last one is 83.4775. Okay, and you see on the right hand side are the sellers. So somebody has placed an order to buy 55 lots at 83.4950. Now, he wants to sell. So the person who has offered to sell at a lowest price will be sitting at the top. Now look at the two. Are they matching? No. Because somebody wants to buy at 83.48 and somebody wants to sell at 83. That's why it's not matching. Okay, so either new person will come and he'll accept, or the seller has to, bring down the price down, or the buyer has to make the adjustment and modify his order so that he knows that it price somebody's able to sell at 83.49, so he matches. The moment he puts the price, I modify my order at 83.49, my order will get executed. Okay, now then it will be 83.49, 83.50, 83.50, 83.5050, 83.5075. So you will get a full window about who are the people who have placed the orders, and look at how many people wanted to buy. 27,600 last line, 27,675 bid are the bids. Okay, and the offer which is asked are 23,844. So the buyers outnumbers the sellers, isn't it? That means there is more buying, than the selling pressure. Okay, so which would normally means like advanced decline ratio in the stock exchange. If more stocks are advancing and less are declining, so you say that there's a bullish this thing. So here also you can assume that the market is running fine, and you would like to place the order. Okay, rather than wait that the dollar may cancel, come down. Absolutely. So this is one logical conclusion. Of course, you can't mix everything like this because there's so many parameters. So this is one, parameter on which you can think that there are a lot of people who are willing to buy and very less people who are willing to sell. So there's a demand is, more than the supply. Okay. So when there is more demand, chances are that in this particular time frame, the dollar is going to appreciate further. Okay. So let me just take you to the stock exchange for a while to understand. So, we are basically, in the currency market. Okay. So, when you go, this is the, Bombay Stock Exchange portal. Okay. Fine. So, I am interested in currency. So, you can buy stocks, you can buy mutual funds, future and option stocks, commodity, currency. So, we are in the currency. Okay. So, I want to place an order. I just placed the order. Okay, so I'm on the window on a stock exchange to place my order. Okay, so I'll choose futures here. So you have futures, you have options. Then there's something called future plus. So I'm just ignoring that. So let's talk about first futures. So now I'll put my so you put your USD INR. Just you put USD, will get it. Okay, now you will have a lot of choices. Okay, you can even look at here rather than looking at here. So now you can just see the spot price is 83.3725. Okay, and for various expiry days, the last trading, somebody has just concluded the deal, so his order is getting reflected in the system, the price, not the order. So 28th of November expiry, 1st December, 8th December. So these are weekly contracts, and then you can just see it can go right up to October. Okay, so if you see the 28th November, which is what is today date? 26. So 28th November is the expiry day for the November month. Okay. So then January. So December. December we have about 4 weekly contracts, and last is the monthly contract expiring on 27th, 29th of December. Okay. So there are 4 weekly contracts and then one monthly contract. December. Then we have January. Then we have February. So here we are getting only December, January, February on the last, working day or 2 days prior to the month is called the last working day when the, deals get settled. Okay. So this is called the expiry day. So look at it. You will find, it's starting at, the dollar was 83.838. Okay. And now, the dollar after 12 months is available at 84 point. So it's giving some indication, 84.572. Just minus the two number, take 80, put it on a calculator or your this thing, 84.5725. If you have to book an order for October 2024, then the price is somewhere around 84.5725 minus the price as of today, which is for the November contract is 83.38, isn't it? सो माइनस कर दो और 83.38 से डिवाइड कर दो और इनटू 100 कर दो, परसेंटेज निकाल लो. सो व्हाट इज द प्रीमियम फॉर डॉलर 1 year or 11 months forward here, because it's 28 hours, so it will be 12 months. Assume it's a 12 months, okay? So you will get around 1.5% kind of a premium. Just work out. So what you have to do is basically, if you look at 84.57 minus 83.38, it tells you, are you getting it? 1.43. So it's about, roughly around 1.5%, which is the interest rate differential between the two countries. Okay. Or inflation rate differential. Okay. Fine. Like, in America, the inflation is about, say, about 5%, and India is about 6.5%. So that means 1.5%. So whatever is there. So you can just gauge it that the dollar is trading at a premium of around 1.5% 1 year down the line. Okay, which absolutely gels with our this thing. Okay, fine. So then here I choose, madam, some problem with you? You are not following. It is. Are you able to on? नहीं, website आपको नहीं हो. This is a paid site, so that's why I'm there. Okay, fine. So you won't get it. So don't try to go to the stock exchange unless you have subscribed. You, of course, if you have a window of buying stocks, any one of you, you can go to that window and you will be seeing the same thing. Okay, just listen to me at the moment. आप अभी देख लो, you will be able to understand. So don't worry about. Is it not clear here? Because the projector. So anyway, so देखो ऐसा इसका भी महत्व नहीं है. अभी जब मैं स्लाइड में जाऊंगा तो you will be able to understand. Okay, so let me just talk about here, then I'll go to the slides. Slides are visible, na? Fine. So here,
Inflation rate differential is between its nominal interest rate differential or real interest rate differential.
just hold on. अभी हम उसमें डॉक्टरी नहीं कर रहे हैं, अभी करते हैं, अभी करते हैं. Okay. So we are. So when I have to, when I have to make my payment, which month? January. So I'll take January contract, isn't it? So 29th of January. So it is 83.50 here because I made on 24th. So rate was different. Now it is available at 83.50. So I'll say buy. Okay. So I'll put a buy order. Okay. अभी कुछ visible है? वो चीज विजिबल नहीं हो रही जो फिगर आ रही थी वहां पर. सो आई प्लेस अ बाय ऑर्डर. सो आई वांट टू प्लेस अ बाय ऑर्डर ऑफ 100 कॉन्ट्रैक्ट्स. ओके, बिकॉज इट विल बी इक्वल टू $1 lakh, because one contract is equal to $1,000. So it will be, now how much margin money I am to pay? 2,09,200. So this is the margin money. Can you see the margin money? So it is basically this 2,09,200 will be the margin money which I have to pay. Okay. Then you can see the bids and the window, same window, which I was explaining, which I just took a shot there. So you will get the 5 best bids and 5 best offer bids. Okay. Offer price and the bid price. And then you can just see, and then, make how many people are, buying 18,000. And how many people are selling 18,000. So there is no buying or selling. The buyer and sellers are equal in this number. Fine. So I just close this thing and come back to the, to my slide, and then we'll go back again later on. First, let's understand this question. Okay. So it was just to understand there are 12 contracts you can see on a contract on a stock exchange. So that was the purpose basically. Okay. Now what happens? Here, since you are an importer, okay, as an importer, uh, you will be losing if the dollar goes up, isn't it? If you are not hedged yourself, okay. So, if you are an importer, that means you are short of dollars. You don't have dollars, you are short of dollars. So, you have to take a long position in the stock market. Long position means buy. So, you buy. Okay. That's why I have bought it. If you buy dollars, so if dollar goes up, I'll make money in the stock exchange. But in my actual transaction, I'm going to lose money. Both will get offset. So I'm hedged. So that is the purpose, and you can see in the second slide happening it. Okay, or I say, as a speculator, I'm bullish on dollars. Okay, I'll buy dollars. Even as a hedger, I think the dollar will go up. So that means my position is bullish position. If I'm bullish or I'm short in dollars, I'm going to buy dollars. Short because as an importer I'm short. That's why I'm taking a long call. Okay, and if I'm just a speculator, I don't have underlying transaction, and I think the dollar is going to go up. I'm going to still take a long position, or I'm bullish on dollars. Okay, if the dollar goes up, I'm going to make money. So what I've done is I've taken a long position by buying dollars at 83.4875, okay, and paid a margin money. Now there can be two scenarios. Now, since I am an importer or exporter, I am not a speculator, so I'll wait for the month end expiry. Okay, I could have not even waited for the expiry and taken my position in between also. So I'm not discussing that scenario. That will be discussed in the last scenario. Okay, the first scenario would be on month end when I am supposed to make a payment. I'll wait till the time. Okay, कि 29 December आएगा, so I'll on 29 January this thing the RBI announces the rate, which becomes the rate on which stock exchange is going to settle my at the expiry. If I don't settle it anytime before, then at the expiry, my position will settle at the RBI reference rate. So I have been given two choices to do it before that or wait till the expiry. On that day, if I don't do anything, automatically my transaction will get settled. Okay, assume it is getting automatically because I'm going to make a payment on 29, so I'm waiting. Okay, so I waited, it became 84.98. Okay, fine. Okay, so what happens? I'm sitting on a cash profit. So I took a position at 83.48 and now it is 84.98. So I make 1 rupee on 1 lakh dollars. So I'm sitting on a profit of 1,50,000. Is it okay? Now my money will get released because I've got my money. Okay, transaction is over. Whatever margin money I paid, it will get to my account. Okay, just think that simply way. Okay, then importer has to pay now. Now the importer, because the rate is 84.98, so he's going to go to the bank. Okay, and say that I need dollars because that spot transaction is separate and this is just a transaction to hedge yourself. Okay, because stock exchange has given me 1,50,000. Now I go to the bank and buy dollars at 84.98, which is a spot rate on 29th of January. So I pay 84,98,000. So what is my net outflow? 84.98 minus 1,50,000. So that means my total outflow will be only 83,48. So that means I'm hedged at 83.4. So whatever position at dollar I have taken, that will become my hedging position rate. Okay. So whatever happens, my outflow will happen only at 83.4875 if the dollar goes up or dollar goes down. Let's take about the second time. Suppose the dollar goes down. Since I have bought dollars, I am losing now. So if I'm losing, I have to pay to someone. How much? I know it is come down to 82.48. So which means I'm lost 1 rupee. Okay. So I have to pay 1 lakh to the stock exchange. It will be given to the seller. Margins will get released, and importer has to pay now at 82.48. Okay, if suppose I have not taken a hedging position, I would have gained, but since I am hedged, so I have lost 1 lakh rupees. My hedging will be at 83 point. So whatever happens, I will be at 83.4875. Is that clear? Whether the dollar goes up or goes down, I am hedged. If I have taken a futures position, now if I have taken an option position, it's a different game. Okay, fine. There I may get the benefit. But I'm going to talk about that later. So here, whatever happens, I am insulated from ups and downs of the dollar movement. Okay, so I'll just take you back. Okay, so here we start. Just to again recap, I'm an importer. I have to pay $1 lakh to someone, and the payment falls on 29th of January. Luckily, it falls on the day when the expiry day is there. So that's why I mean, it's a coincidence. I mean, this thing I have done, framed the question like that. So the on expiry day, which is 29, when I go to the window of stock exchange on 24th, okay, I find the dollar is trading at 83.48. I found this apt rate. This is okay. Dollar is not going to go down or go up. So I'm going to book my dollars at this rate. So I punched my orders at a limit price of say 83.4875 or at the market price. After seeing the bids and lots, I know my orders will get matched with the other guy who's sitting and who is want to sell. So I place the order at 83.4875 and I have to pay a margin money, which is 2.5%. So I pay that. Okay. And then I look at this window and decide and book my order. So now now I'll be waiting till 29th of January. Okay. Now, what happens actually is there is something called daily settlement and monthly settlement. The stock exchange does a daily settlement. If the dollar goes up, I'm in a winning position. My account will get credit of that amount. Next day, if the dollar goes down, money will be taken from my account. So every day, gains and losses are coming into my account, moving in and out. Okay, fine. On the 29th of January, only the last day, the RBI reference rate and day before. What is the difference? That will be coming to my pocket or going my pocket. Okay. This is to make sure there is a no counterparty risk. So there was long back in India, I mean, where, when the Harshan Mehta scam broke out, before that, there's a Badla trading where there was no such mechanism of daily settlement. So there was some committee formed, JR committee or something. So they recommended that there should be a daily settlement. So nowadays, there is a daily settlement which is happening to make sure that, and apart from that, the stock exchange is also collecting a margin, okay, based on a software called SPAN, which basically calculates what can be the maximum one-day loss or gain to a person. Rather, they are interested in loss, so that if something happens in a day, so at least margin money will take care of that. Okay. हाँ जी. Okay. हाँ सर, वही मैं कह रहा, सुन लो तो सबको सब पता चल जाएगा. I know, the places at where I stuck up, it doesn't go into my head. I try to find answers. So the same brains works the same way. Okay. Fine. So anybody? Yeah. हाँ, वो माइक दो प्लीज. उस उतनी दूर से मेरे को सुनाई नहीं देगा. हाँ, रोल ओवर्स. या हाँ, अभी अभी पहले हम सिंपली कर लेते हैं, फिर उसमें भी चलेंगे, रोल ओवर्स में भी चलेंगे. ओके, हो गया. आप तो सर उसका क्वेश्चन हो गया. एंड हर वॉइस इज क्वाइट ओके. या
You said that whenever we take a long position, उसमें जो profit होगा, that is when the actual transaction happens. If in the long position we are getting the profit, in the actual transaction we will be incurring a loss and ultimately it will level out.
या या
Actual transaction में जो loss होता है वो एक step में सर.
हाँ, वही बता रहा हूँ. Suppose now, let's say, what we're talking about first, the profit. Okay, fine. वही आएगा उसमें, दोनों compensating है. So suppose on 29th of January, the dollar has gone up. Okay, fine. So as an importer, I have lost the money, but the bet I have taken the stock exchange has given me money. Okay, so that means my gain from the stock exchange will get offset by my actual position in the imports, so that I remain there. I remain totally hedged. So here I am making a gain. Now I will get a gain of 1,50,000 from the stock exchange, from the guy who has accepted my position. Okay, fine. So the margin is going to get released on that particular day because that's the last day and the transaction is concluded. So then importer, what importer is going to do, because the rate has been given spot rate which is 84.9875 by the RBI, assuming that's the rate which has been taken by the bank. It will be more or less, some ticks here and there. Okay, so he is going to, I have to go make a payment to my banker. How much? 84,98,750 for $1 lakh. When I go to the bank, I say I require $1 lakh because I have to make a payment to some person abroad. I have a liability. He says, okay, you pay us 84,98,750. We will give you $1 lakh so that it can be remitted to your person abroad. Okay, so that's a separate transaction. Now I want to know how much I have actually paid. Okay, net, what is my actual outflow? So I have given to the bank 84,98,000, but got 1,50,000 from the stock exchange, which means my net outflow is 83,48,750. So if I divide this by 1 lakh, so my rate comes to 83.48. Yeah.
So this gain or losses, this is notional, right? Because we are immune to whatever the market fluctuations are.
See,
So
listen.
this would be
What's your
notional.
name? What's your name?
Jasmine.
Jasmine. Now, Jasmine, this is a real gain or loss.
Because
Actually, only thing is this is helping me to remain at, hedge my, I'm fixing my rate of 83.48. I try to, because today the spot rate, look at the spot rate. Spot rate is 83.34 today. And I am going to make a payment in January. Okay. In the month of January, the spot rate can be any. It can be even touching at 85 or 86. Okay. Whatever. So I want that, I should fix my rate. So today, when I go to the stock exchange, I find the rate is 83.4875. Now, I like this rate. Okay. I say, okay, this should be my rate at which I am supposed to make a payment to my importer. Now, this is not in my hand. Okay. I want to fix the rate of 83.4875. This is the rate at which I want my payment should happen to the supplier. Now, how can I do it? By taking a long position on the stock exchange. By taking a long position on the stock exchange, by buying dollars at 83.48 from someone, if the dollar goes up, so the other guy is not going to give me dollars, okay? He's going to make me the difference of the two. So he has lost, I have gained. So you know what happens? Now here, the other guy has lost the bet, I have gained. So the cash settlement will happen and I'll get 1,40,000 rupees from him. Okay. Now all this process will mean that at one hand I'm making a payment of at 84.98, which is the today's spot rate, which is on 29th of January. But at the same time I'm getting some amount from the stock exchange. Okay, fine. It's not like notional. The only thing is that ultimately my purpose of making a payment at 83.48 has been delivered.
So this is what I think she's trying to say that once I fix my payment rate,
हाँ हाँ बिल्कुल.
apart from that,
If
apart
I'm
from
making a
that,
gain
whatever
or
gain,
loss, it doesn't matter.
doesn't
हाँ.
matter.
If you want to say that, it's okay.
Yeah.
Fine.
I think this is what differentiates it from options. I think.
Yeah, yeah.
and also so this you told the margin will get released. Is it not out of pocket cost?
No, no, this is a security deposit which you are given for counterparty risk, so that it is going to cover. That's why I'm just going to now take you to the before we move to as an exporter. I'll just take you now to the part of theory, which I just wanted to. Okay, sorry, this is just an example here. So theory is coming in this slide. So I'll share this. I just revised it yesterday because I was taking the current date. Okay. So there's some little bit theory, not much here. Okay. So we have covered this. Okay. Now you'll understand what is it. All weekly expiry contracts will expire. Now, all contracts other than weekly will expire 2 working days prior to the last business day of the expiry month at 12:30. So in this case, the second box, 2 days prior to the working day on 29th of January was the date. Okay. Fine. So transaction is happening on the last working day. Okay. Now contract size, we all know about it. Okay. And there is a window which I have given this thing. So I'll go and just there also later on. Go to National Stock Exchange and see.
So we don't again earn any interest on margin money.
हाँ जी.
Margin money में कोई
नहीं नहीं, no interest, nothing. Okay.
फिर इसका लॉस कहाँ से सेटअप होता?
किसका?
जैसे इसमें ट्रांजैक्शन में अगर लॉस हो
हाँ
तो
हाँ, जस्ट होल्ड ऑन, लेट मी जस्ट कंप्लीट दिस. विल ये भी आपको समझ आएगा जब आगे चलेंगे. ओके, जस्ट होल्ड ऑन विद द क्वेश्चन. Okay, so margin, we are supposed to make a margin. Okay, the margin is span plus exposure margin. Okay, so there are two kinds of margins, span and exposure. Usually span is about 2% and exposure is around 0.5%. Hence roughly around 2.5% is the overall margin. So the stock exchange is going to take 2.5% margin. In the stocks, it depends upon the volatility of that stocks. Okay, like Reliance, suppose it's highly volatile, high standard deviation, higher beta, so that will carry a higher margin. Okay, here also it's basically the currency pairs which are more volatile will have a higher margin. Currency pairs which are less volatile will have a lower margin. At the back end, it moves like that because the span has been designed to do that. Span collects the data at the back end, the dollar versus rupee movement, and throws out a margin. Okay, fine. The settlement price, RBI reference rate on the final settlement. Fine. RBI reference rate on the day of final settlement. The closing price of the spot, which is the closing price. Okay. Now this was just some theory part which I explained. Okay. Now let's talk about yet another case. Okay. Just hold on. Yeah. Span is a, you can just Google out and you will find it. Okay. Span is basically a software designed somewhere in US, according to my knowledge. And, it tells you basically, how much margins you should collect whenever there is a futures option trade. It covers basically based on the data of a particular stock or a particular currency pair. It gives you that how much you should collect, so that 99% of the time, one day maximum possible loss can be absorbed by that span margin. Okay, so in simple this thing. Now, for further, you can just refer to Google and understand more detail about that. And with I have prepared a slide also, full margin slides is there. Okay, which I may share with you. Okay. Now, suppose you are an exporter. Okay. Now, if you are an exporter, actually you are long on dollars because you're going to get dollars, say after a month, 2 months, 3 months on the day when you're going to get. So you're long on. So you will take a short position. That means you're going to sell dollars. Okay. As an importer, you bought dollars. As an exporter, you're going to sell dollars. Okay. So on second, sorry, this was, I just updated the slide. I'll go to this thing. So on 24th of November, XYZ Limited wished to book its inward remittance for 29th of December, or $1 lakh. Now he's getting the payment next month, okay, from abroad. So he goes to the stock exchange and looks that the dollar future is currently trading at 83.4, same price because it was 24th, the price is same, expiry on 29th of December. Okay, fine. Now, of course, the price can be different because the window is basically this December and not January. So in January, the price was 83.4, assuming the same price. Okay, let's see. Okay, I have not changed the price. I should have gone and seen what is the price. I just kept the same price because they're two different months. Okay, the prices may differ. Okay, fine. So I think that I missed out. So the spot rate is 83 point. This price will be the same, 83.33 on 24th. Now dollar future can be a little bit here and there for December. Okay, but I have chosen to keep the January same price. Okay. Now number of contracts 100. Okay. Now what he's going to do? He's going to sell dollars. Okay, because he thinks that the dollar is going to fall. Okay, dollar is going to depreciate and he's going to lose money. Okay, fine. So if he takes this position, if the dollar falls in the stock exchange position, I'm going to make money. Okay, if I've sold dollars at 83.4875 to someone, if the dollar comes to 83, I'm making 87 paisa of gain, isn't it? Because I've sold to someone. Okay, bhaiya le lo. On say 29th of December, we will settle the deal. On 29th, suppose the dollar price falls, I'm sitting at a profit. If the dollar price goes up, I'm making a loss. So then he pays a margin, which is 2,08,000 something. So he pays it. Now the first scenario, when the dollar comes down, so I'm happy. As a hedger, I'm happy because on the stock exchange position, I'm going to make money, but I'm going to lose money as far as my exports are concerned. Okay, because I'm going to get less, rupees per dollar. As in, if I have not taken up, this position, I would have lost by about what? About a lakh of rupees, isn't it? So 83.48 minus 82.48. So I sold the dollars at 83.48 when I took the contract, but today the rate has come to 82.48. So which means I am actually making a profit of 1 lakh. Okay, fine. So margins will get released, but now I will get that 1 lakh dollar from my exporter, and bank is going to give me 82 lakh 48,750 because when the dollar comes to my account, bank is going to convert that into rupees and give me 82 lakh 48,000. But I am going to get extra 1 lakh because I've taken a position. So which means my total inflow will be 83 lakh 48,750. So which means I'm hedged at 83.4875. Is that okay? Fine.
So in that case, basically, if I've taken a future contract, bought a future contract, or if I have long it or sold it or shorted it, so it does not matter whether the market goes up and down.
No.
I'm not worried much.
I'm not worried about the market. So I don't want the gain or loss accruing from the dollar movement. Okay. I'm just interested the price at which I have, booked it. Okay, so that is the price which is going to be become final for me. Okay, and I know this is my price, so that I can book my business transaction according to that price. I can make a profit or loss. I do for my costing purposes. I'll be using this.
So
Okay,
I will not worry about the market anymore. I
yeah,
just fix the price and whatever markets happen, I know that ultimately it will be settled down
yeah,
to
yeah,
zero loss or gain.
absolutely, absolutely. Okay, so that is the purpose here.
And my business will run smoothly. I do not think
I
much
am not
about
worried about, I don't want any gain or loss happening from the dollar movement here and there. So I am totally now, my mind is shut up from what is happening in the foreign currency market,
focus on
because
business.
I can just focus on business. That is one way. But now people are greedy. So, they say ki, bhai, agar to if there's a profit, I should get it. If there's loss, I should not, it should get hedged. So that there's an options
They
market.
pay me for that.
Okay, fine.
So,
So
sir, in this question, the spot rate was bid in the case of exporter, and the previous example of importer, that would be an ask
ask,
rate.
absolute offer. Yeah, absolutely right. Now, let's assume that dollar price goes up. Okay, it goes to 84.8975. Now, in this case, since I have sold it at 83 point something, I'm sitting on a loss. So I'll be making a loss of 1 rupee 41 paisa, which is 1,41,000. So I'll be, making a loss in the stock exchange. But if I have not taken this position, I would have got 84.89 from the, for my exports. But since I have taken a position, so that gain which is arising because of the favorable position in the market, I am not going to pocket that. So though I will be getting 84 lakh 89,000 from the banker, okay, 1 rupee 41 paisa more than what was the price, a month back. But my total gain will be, I'm hedged at 83.4875. So whether I'm making a gain, I'm not pocketing it. If I'm making a loss, I'm not pocketing it. Okay, on a net basis, that's a notional
Sir,
thing.
but in this stock market, if it is a gain, then wouldn't be taxed after once? For example, in earlier transaction, I was having some,
Stock
both
exchange
are
gain
different
also.
transactions.
Yeah,
Actual, my dollar payment as an importer, exporter, and the stock market transactions are different. So it will not club it. While for taxation purpose, might get taxed if I earn in
yeah,
the stock
yeah,
market. So that
definitely.
I might be having some loss at the end of
But
the day in that
sir,
case.
I don't think so it would be considered for a
So we'll talk about taxation later on, next week. Okay, when we finish the options. So the question is valid. We'll just park it for some time. Okay, fine. So that's a very good question. So I'm not answering at the moment. I'm reserving it for the next week. Okay.
So, sir, from the point of view of exporter or importer, the
So there are
cost,
always some transaction charges also which you are supposed to pay. There are so many things. Okay.
that's what I was
Yeah.
about to ask. The out-of-pocket cost for an exporter or importer would be
So
the interest amount
so that is,
lost and the margin which
absolutely,
you are
that is only
losing that.
0.1% kind of nowadays. It's very
That you
small.
would be losing.
That will be extra cost. So I'm ignoring the transaction
That
cost at
would
the
be the
moment.
only cost that would be
Yeah,
losing.
yeah, yeah. Okay. Is that okay? Fine. Now, if you are a speculator, so let's finish that. I think just some few minutes are left for the class.
No, no, sir.
2 बजे तक ओ मुझे लगा 1:30 बजे है ठीक है there's a lot of time good. So example on speculate, if suppose you are a speculator, you don't have any underlying position. Okay, neither you're an importer nor an exporter, so you think the dollar is going to go up. Let me speculate in dollar, or if you think the dollar will depreciate, so you can take a position. So X is a speculator, he's bullish on dollar. On 24th of November 2023, X speculates for 29th December contract of 1 lakh dollar. Okay. And X future, dollar future is currently trading at 83.49, for example. Okay. And he thinks that 1 month down the line, the dollar will go up. Okay. So he takes a long position. He buys dollar. Okay. Because if he buys dollar today at 83.49, if the dollar price goes up, he makes money, isn't it? So he takes a long position. He's just a speculator. Okay. He's neither an importer nor exporter. So he goes to the stock exchange window and he finds that dollar future is trading at 83.49. I've limited myself to just two decimal places here. Okay. The monthly contract is expiring on 29th of December. Okay. So he's taken a view for December. कि दिसंबर तक डॉलर ऊपर जाएगा. Okay. So he takes a long position for currency futures. He deposits the same margin money like you would have done if you were importer. Okay. So the current rate is 83.33. Now what happens? Booking profit before the expiry. Of course, this was also open for the importer and exporter, but as a speculator, I'm telling you. Okay. Even he would have done it. Okay. So booking profits before the expiry. So he has either to wait till expiry or he can just be out of the trade before the expiry. Two ways you can do it. On 10th of December, still about 29th December when the expiries happen. On 10th December, the November futures contract is trading at 84.10 as against 83.49 when he entered the contract. Now it is trading at 84. So dollar has moved up, isn't it? So now, according to his own thinking, the dollar is going to depreciate in the next few days. He's not, bullish about the dollar from 10th onward. 10 के बाद उसको लगा कि मैंने कुछ पैसा कमा लिया है. या तो he wants to limit his gain. He thinks the dollar may go up, but I'm not worried about that. पैसे कुछ बन चुके हैं मेरे. So what he'll do, he squares up his position. So how can you do that? You square up your position. Whatever position you had taken earlier, you will take the opposite position in the same contract month. When you bought it, now you're going to sell it. Now the buyer and the other person can differ. I bought from him, but I'm selling to him. It can happen because I don't know. Stock exchanges, I don't know to whom I'm buying, whom I'm selling. So I'll take another position. Now there'll be two legs. One a buy leg, another sell leg. Okay. So he squares up his position. Squaring up means taking a opposite position in the same contract month. Fine. Even if suppose both the positions are open, if I'm making money in this position, I'll be making a loss here on. So at the end, there will be zero-sum game. Fine. So what will happen? I have booked my profit at 84.10. Now he sells. What he does first, he takes an opposite position. First he bought it. Now he sells at 84.1. No margin required because I have already paid a margin. Okay. So this is basically the second leg. So stock exchange is not going to ask me another margin because both are opposite direction in the same month. Had the month changed, then they would have asked me the margin. Okay. The cash profit, I have already sitting on a cash profit, which is 84.10, which is the price on 10th, and 83.49, which is the price when I took a long position. So I am sitting on a 61,000 rupees profit in a matter of just 10 to 15 days. Okay. Or maybe 6 plus 10. 16 दिन में I made a profit of 61,000. I am squared up my position. By taking one long position, one short position, and gaining 61,000, margin will get released immediately on the expiry. So on that day, assume if both the positions are open, thereafter, whatever happens, dollar goes up and down, both will have equal opposite this thing, and neither I'm going to make money nor I'm going to lose money thereafter. Because one leg will be giving me money, another leg I'll be losing. So the stock exchange thinks that the transaction has been, there is no open position, the open positions gets over as far as me is concerned. Okay. Fine. So that one open position is over for the stock exchange. We'll talk about what is open position later on. So just to understand, the moment I take opposite contract in the same very month, in the month of what it was, December. If I bought in December, I should take an opposite position in the month of December. If I bought in January, I should take an opposite position in January. If I bought in February, I should take an opposite position in February, not any other months. Okay. If I do the same thing in the same month, then the positions get settled. Okay.
Taken opposite position before the expiry of the credit.
Before the expiry. Before the expiry.
So if we don't take an opposing position,
Then whatever is the RBI rate will apply, and the transaction will be settled at that price. Is that okay? Fine. So this is the example to explain whether you are a speculator, whether you are a hedger, whether you have import or export transaction with you, or whether you don't have. So
actually speculator is making profit, actual profit.
हाँ वो actual है, वो notional नहीं है. So we just go to the stock exchange again to just look at. Fine. So then we talked about sell position. Let me see if it's working. Yeah. So sell, select contracts. Oh yeah. Still, but I thought might have, I have to log in again. So I'll just tell you again, okay, right from the beginning. Suppose I am here at the portfolio or somewhere, okay, fine, stocks or somewhere. So now, I am interested in currency. So I'll go to the currency part, okay, and look at what will happen is that, I can, have a place order. I can have open position. Whatever position I open, it will show me how many contracts I'm sitting, where those contracts have not been expired. Then, there are reports, there are smart tools, there are funds, there are orders. Okay, let me just see. So this has a, the currency list also. So what all currencies can be traded on a stock exchange. So these are underlying is Euro INR. Okay. So all the four pair, I mean, Euro, pound, Japanese yen, and US dollar. So these are the currencies which you can trade on. Okay. So let's say I go to place an order. So let's talk about as a import, as an exporter. So here I'll go to futures. Okay. And use USD, say INR. Okay. And select a contract from here. Okay. Go to the contract, this thing selection. So okay. So what I have to do is basically I have to enter some more particulars. Suppose I go to say now 29th December. Okay, so this example I okay. So I'm going to sell how many 100. So I'm going to sell. So I have to pay a margin of 2,08,000, which will get populated, and then it will say the order type, the market or order. I mean limit. So if I put a limit here, which is limit is auto populated as 83.4175, which is the last traded price. Okay, I can even change it. So I can make it 83.38. Sorry. So suppose I make it 390. Okay, so it will not accept because the tick size is 0.25. So let me see. Okay, so let me just 75. Okay. So if I put like this, then I can, then I can just go to the contract. Okay, fine. So so 29th December is the date. 83.41 is the last traded price. I can view. Then I can just take a position. I can sell. Okay, and go for 100 contracts. Okay, and then I can, then I can see the best bid, this thing. So this window is available to me. So I can take a call based on that. Okay. And what else? Then I just press place. So the order will go for execution. So it will ask for money, the margin money, which I don't want to give at the moment. So I'll just walk out from this contract. Okay. Fine. So, so let's talk about now some more, understanding about this thing. Yeah. Is it clear? Now, any questions you have? So this we have already done. So there are, currency contracts are in 4 pairs. Some cross currency pairs are also available, which are Euro USD, Pound USD, and USD Japanese yen. So you can even use them. Okay. Uh, okay. Just can you read?
Currency future contracts specify a standard volume of a currency to be exchanged on a specific settlement date. They are used by MNCs to hedge their currency positions and by speculators who hope to capitalize on their expectations of exchange rate movement.
So just read them. Whenever I feel like that it requires explanation, then I'll explain it. Otherwise, they're simple ones. They're used by MNCs. We know that. Okay.
The contracts can be traded by firms or individuals through brokers on automated trading systems, example in India through NSE. Participants in the currency futures market need to establish and maintain a margin when they take a position.
So, okay, just hold on. So this we have already covered. So this is just a duplication. Okay. So now, yeah, read. So the tick size is 0.25. Okay. So it moves in a tick size of 0.0025. So next tick size will be 0.0050. So you can't place a bet. It has to be in this, minimum movement of this thing. Okay. Trading hours Monday to Friday. So you can place the order anywhere time between 9 a.m. to 5 p.m. on the currency market. Contract cycle, we know 12 monthly contract cycles and weekly contract cycles. Okay. Last trading we know is we have already done. There is a final settlement which happens on the last working day, excluding Saturday. If Saturday is there, so 2 days is counted before that Saturday. Daily settlement price. Now there is a daily settlement price mechanism and there is a final settlement price. Just read it.
Daily settlement price calculated on the basis of the last half an hour weighted average price across exchanges. Final settlement price RBI reference rate.
Now, daily settlement price is the last half an hour weighted average. Are you aware of that? Any who are aware of this? हाँ मार्केट में आप स्टॉक एक्सचेंज जाते हो तो जब स्टॉक मार्केट क्लोज होती है 3:30 पे ओके So Nifty and Sensex, at whatever price it closes, it readjusts within few seconds. So they take the last half an hour, movement of the Nifty and stock exchange. On the basis of the weighted average, they calculate what should be the price. So if the last second or last 1 minute the price the Sensex has gone up by say 500 points, but you'll find that the movement will be only 200 points or 100 points, because they will do the average of the movement of the stock prices or the Sensex or the Nifty based on the last half an hour average. Okay, because a lot of fluctuations can happen during the last half an hour. Okay, the market can have wide swings. Okay, fine. So to bring out a better price, so they make a half an hour weighted average price. So that will be the price for the settlement.
I think the difference between the crypto market and this stock market, I would be this daily settlement only.
Yeah.
This thing doesn't happen in stock market.
Doesn't happen because that is a risky market. So here there is a mechanism which is used by the National Stock Exchange. Yeah,
This is the major difference.
should be.
volatility
हाँ जी,
volatility कम करने के लिए
नहीं वोलेटिलिटी तो हो चुकी है.
Part of this.
अब वो रिस्क इतना ज्यादा ऊपर से नीचे मार्केट हो रही है, तो उसको जो है प्राइस को वेटेड एवरेज कर देते हैं फॉर द सेटलमेंट, बेसिकली फॉर फ्यूचर एंड ऑप्शन सेटलमेंट. Okay. The purpose is that somebody should not, I was, in a winning position a half an hour back, and I've lost everything in half an hour's time. It can't be like that. Okay. So the price has to be the thing. हाँ, नेशनल स्टॉक एक्सचेंज का भी और बॉम्बे स्टॉक एक्सचेंज का, दोनों नहीं, दोनों का अलग अलग होता है. वहां पर जहां पर आपने पोजीशन ली थी, सपोज आई हैव टेकन अ पोजीशन नेशनल स्टॉक एक्सचेंज, फॉर मी द नेशनल स्टॉक एक्सचेंज लास्ट हाफ एन आवर वेटेड एवरेज मीन. Normally it would have the same, almost the same. Okay, fine. Okay. Then the contract size we have already done. Settlement. Currency futures in India are cash settled and not physically settled. For forward contracts, they are physically settled. Okay. There I have to go to the banker and deliver or take delivery or give delivery. Here, no delivery happens. Stock exchange is not going to give me any delivery. Okay. Fine. So I was just reading, long back this thing. Somebody in US has actually placed an order for some 1 lakh cattle. Okay, and he forgot to close it. So he got a call from the stock exchange कि आपकी 1 लाख cattle आई हुई है हमारे यहाँ पर, ले जाओ, जगह ही नहीं रखने की. So those days, there was a physical settlement happening way back, about 1940s, 50s. So he just forgot to, book reverse the order or settle his deal. So तब physical settlement होती थी. So, okay. Currency futures in India are cash settled and not physically settled. Settlement, daily and final settlement. Okay. If you don't close your currency future contract before expiry, the reference rate fixed by RBI will be considered as a closing price. Now, in stock markets, game is totally different there. I mean, hello? हाँ हाँ हाँ, आप तो कितने 2 बजे बुक कराई थी मैंने ना. हेलो. हाँ, इनको बोलो कि प्रोफेसर को पिक करा, प्रवेश आगी, मेरा नाम दिया हुआ है ना. हाँ, तो अंदर आ जाओ, गाड़ी पक कर लो. ओके. नहीं, हमारा ये कौन सा एकेडमिक ब्लॉक है ना, एकेडमिक ब्लॉक में बोलो जाना है मुझे. हाँ, बस आ जाओ. Okay. So if you don't close your currency contract before exercise, this will get also recorded. So I have to edit it. So if you don't close your currency future contract before the expiry, the reference rate of RBI will be considered. Now, I was just talking that in stock market, there is a delivery mechanism, in future and options market. We'll do that when we do the stock market. Okay. So the final settlement is the RBI exchange rate published by RBI in the press release. Now, for this is the last day the RBI publishes. So we'll for the dollar as well as for euro, Japanese yen, and everything. Okay, fine. So daily mark to market settlement. Just read it.
One of the important features of future contracts is that gains and losses are settled on each trading day.
Okay, so every day the gains and losses are settled between the buyer and seller.
This exercise is called mark-to-market
Settlement. So this is called MTM settlement. Have you heard the word MTM earlier?
Yes, sir.
All of you? Mark to market. It's a very important concept which is used in many, kind of fields. So, whereby, like, for example, banks, when they make their balance sheets. So most of their, assets and liabilities are on the mark-to-market basis. Fine. So that's why when you look at price to book ratio of banks, we say this is quite okay compared to a price to book ratio of any other company like Reliance. You can always use price to book ratio for banks because it is all the assets and liabilities are mark to market. Fine. So I'll discuss that later. Okay. Then this means that the value of contract is marked to market to its current value. Okay. This means the value of contract is marked to its current market value. So this means that. Okay. Fine. Okay. Read further.
The exchange with the help of brokers and clearing house would collect this additional margin.
Okay. So the margin is collected by the stock exchange.
For the loss bearing party, I would pay the same to gain additional risk party.
So there will be, it will be collected from the loss bearing party and given to the profit bearing party. Okay. Hanji? Okay. Just read it.
On the expiry of the future contracts, NBC clearly marks all positions to the final settlement price and the resulting profit loss is settled in cash. The final settlement profit loss is computed as the difference between the trade price or the previous day's settlement price, as the case may be, and the RBI reference date of the future contract on the last trading day.
See, what happens is that the settlement, mark to market settlement is happening every day. So for all other days, it is the future date before, and after. The future day is one day before and future date today. So it is future versus future. But on the last day, it will be the RBI rate versus the last future date, isn't it? So every day settlement is happening. So RBI is not giving you the date every day. Okay, fine. So RBI is giving, but that is not considered. So RBI's expiry date will be considered for the final settlement. So every day the future price is going up and down. Okay. So on the first day when I enter the transaction, at the end of the day, whatever is the future price, if I made, it has gone up, I'll get money. So the future price prevailing at the end of the day, or versus the when I enter the contract, that future price, the difference will be either my profit or my loss. Every day it will happen like this. So the profit and loss is calculated between the future prices only. But the last date happens between the future price of a day before the expiry and the RBI rate at the time of expiry. Is it making some sense?
So
I am able to
if the
explain that.
contract is expiring on Friday, so the future prices for the Thursday last settled price will be considered, and the RBI reference rate on Friday will be considered.
Absolutely. So till the Thursday, up to Thursday, for the long I take the position, the settlement will happen only in the future price versus future price. But the last settlement will happen on the expiry will be based on the spot RBI spot rate versus the future price earlier before. Okay, is that okay? Fine. Final settlement loss profit amount is debited or credited to the relevant bank account on T plus 2 day. So you will get your money in the T plus 2. Okay. Okay.
The settlement price for futures contract is the closing price of such contracts on the trading day.
Okay. So daily settlement price for the future contract is the closing price for such contract. So its future price becomes the closing price for the daily settlement. The closing price for the future contract shall be calculated on the basis of the last half an hour weighted average. So this we have already discussed. Is that fine? Now, this is the last slide for the day. So this is the difference between the forward and future. So forward contract is customized, future contract is standardized. Okay, do you understand that? No need to explain. Now, trading informal over the counter in forward contract, traded on the stock exchange. This is also clear. Participants, it can be banks, brokers, MNCs. Public speculation is not encouraged. So when you're having a forward contract, there is no speculation required. But when you're on the futures contract, you can be a speculator as well as you can be a hedger.
There needs to be a underlying contract in
Yeah.
order to have a
Yeah, absolutely. In Now, only thing when you are having underlying contract, then it becomes a hedging. Otherwise, it becomes a speculation. Yeah. Settlement single pre-specified in the contract. In case of forward, you come on so and so day. This is the rate, and take your dollars or give the dollars, and this is the rate will be applicable in a forward contract. In case of the stock exchange, it will be daily settlement as a final settlement. Risk, counterparty risk is present in case of forward. Suppose the other party is not bank, it's somebody else, and he just closes his shop and runs away. Then you can't do anything. You enter into a forward contract with someone to buy something, and the guy is not there on that day, or he has popped off. The contract, there is a counterparty risk. But in case of a stock exchange, there is no counterparty risk. Okay, fine. Because something even happens to the buyer or seller, the margin money is going to take care of that. Okay. Suppose he doesn't honor the contract. He doesn't deposit the money what is required. Suppose he's losing money and he's not able to give that. So contract will automatically close by the stock exchange, and you are going to get your money on that day if you're making money. Okay. Marketplace, worldwide telephone network. Okay. In case of a forward contract, you just book you can either go to the bank or book a call, make a call to the bank and book a forward contract. Here, it is done on the floor of the exchange. Now, of course, it is all done online. Earlier, it used to happen on on the floor of the exchange. You will go and book your orders on online.
But so this counterparty risk in case of forward contract would
Hanji?
not be this counterparty risk in case of forward contract, it will not be there if one is entering with a bank. Would
Ha,
bank
of
would
course.
not honor
No, bank is going to honor, of course, because when you're dealing with a bank, there are also no counter. Now, forward contracts can happen not only for currency, it can happen for buying goods. Suppose I place an order with a company, okay, that I'm going to buy, this thing for 10,000 rupees next month. I'm going to come to a place and buy it. He says, okay, आजा ना अभी मैं पैसा नहीं है. After 1 month, I go and he says, कि sorry sir, खत्म हो गया, अब तो दे नहीं सकता. But I have just carried money and he says it's out of stock. So he can't do that. So there's a counterparty risk. I have to take him only to court if it becomes so important for me that I'm not getting it. Because the price of this is now 50,000, I bought it at 10,000. That's why he's not giving me the delivery. So there is a counterparty risk. It's not, we're talking about currency when you're dealing with the banks, of course, there is no counterparty risk. Okay?
In case of exchange also, suppose I place a buy order, but it is not matched as you guys
Yeah,
said,
yeah.
but the sell order is on the other side is not matched, then what happens?
So
The
then the
money
order gets expired, then the order is not booked.
is not
So
booked.
at 3 or 5 o'clock, till 5 o'clock, the order will remain the system. Okay. If I place the day order, 5 o'clock, if there is no matching buyer or seller, the order will become expired. But if I have said, let this order be there for next 3 days, so I can just trigger that also to this thing. So it will remain there for 2 or 3 days or whatever days I have specified. Okay, fine. Okay. Any other questions? Yeah, there has to be a buyer. And normally, there will be always a buyer and seller. Oh. Of course, if there is no seller, then then your order will remain not executed. Maybe there is no buyer or seller at that price. So if I'm not getting, I have to adjust my price. I have to modify my order so that it gets booked. Yeah.
Sir, if I have to buy a future contract for say large number of lots and we don't have the shelf,
Yeah.
we don't have such a shelf.
What happens is the order gets split. Suppose I have placed the order for say 100 lots. So I may get my order may get split into five, this thing people. So the order will be placed. There will be five people who are buying from whom I am buying a buy note.
They will be selling at different prices also.
Haji? The prices may also differ. If I put a limit price, so maybe I'll get that same price or lesser than that, but not more than that. If I place a market order, then the prices can differ. It can go up and down. Of course, you can place there's always a percentage of variation which is allowed. So beyond that, order will not get executed. Okay. Let me close because I think that this has gone down. Just hold on. Let me just इसको stop कर